Hey everyone, welcome back to the channel. Today I want to talk about what I think could be an exciting opportunity, and it's currently looking like it would be a guaranteed 20% return. So what this is, as most of you have probably heard, is the recent Microsoft and Activision acquisition. So if you've been following this, Microsoft agreed to buy Activision for $95 a share and about $68 billion market cap. Now, if we look at the stock price currently of Activision, it's trading at around $78 a share. So the difference between 95 to 78 would be about a 20% return. So there's a few things I want to discuss around this acquisition. So I'll jump right into that, and we'll see if this could be a good opportunity for an easy 20% return. So first thing to note that I've actually seen a lot of questions online about is Microsoft is saying it's about a $68.7 billion net cash acquisition. So they're doing it in all cash. But if you were to take the current market cap of Activision, divide that by the share price, you get about 780 million shares outstanding, and you multiply that by $95 a share, you actually end up closer to about a $75 billion valuation. So there's been some questions online of, are you really getting the full 95? Are you not? Like, what's driving the discrepancy? And that's coming from when you acquire a company, you're acquiring them for their enterprise value. So what's happening there really is, think of it this way: Microsoft is paying all cash, so they're going to pay out $75 billion to all the shareholders of Activision at $95 a share. So you would get that $95 per share. Now, what happens though is in enterprise value, you subtract out net debt. So what net debt is it's your total debt less your cash. And in this situation, if we go back to the last 10Q from Activision and we look at their balance sheet, at that point in time, they had $9.5 billion roughly of cash, and they had about $3.5 billion of debt. So that difference there is about $6 billion, right? So they have $6 billion more cash than debt. So let's think of it this way: Microsoft is going to pay out $75 billion to the shareholders, and then instantly what happens is they receive all the assets and liabilities of Activision. So immediately, right there, right, they pay off the debt of $3.5 billion, and there's a $6 billion cash surplus. Microsoft is going to immediately absorb that, and it's going to basically offset the cash they paid out to the shareholders. So that's why you get kind of that weird math of the market cap at 95 a share does not align to the acquisition price at 95 a share, and it's because of that net cash position, because they have more cash than debt. So that's kind of the first thing I saw, so I thought I'd just talk through that. Now the second part really is, why is it trading at a 20% discount, and is it a guaranteed 20% return? So a few things to note here. The first thing is this acquisition isn't scheduled to close until June of 2023 is what they said. So you're looking at tying up your capital for about a year and 5 months right now, a year and 4 months, something like that. So your capital is going to be tied up for a year and 4 months. So that's a, cost to capital. Do you have other opportunities you could invest in that time frame that would be a better return? So first, it's kind of that holding period and cost of capital. The next thing is the certainty around this acquisition happening. I think this is an interesting one. I think there's kind of three main things that break up an acquisition, and I'll talk through them here. The first one is getting shareholder and board member approval for the acquisition. So in the announcement, they announced that the Activision board and the Microsoft board have both already approved this acquisition. So that's a good sign. We have the boards on our side. Now what we have to worry about is shareholders. So from the Activision side, if there's someone with a large position, an activist investor, they may kind of start chiming in now and say, hey, whoa, wait a second here, Activision, I don't know if we're ready to sell ourselves. Why don't we run an auction process? Why don't we see if someone else will pay us more than Microsoft? This happens from time to time. Usually it happens on smaller companies. A company the size of Activision, there's not a lot of companies out there with $75 billion cash that can pay to close this transaction. So it's a pretty small universe of other potential acquirers. So I don't think that there's a big chance of that happening. And to be honest, when something like that does happen, sometimes the original acquirer will be like, we're dropping out. We're not going to continue this negotiation, and we're done. So I don't really think that that's going to happen. The alternative is if there's a big investor on the Microsoft side, right, they could come forward and be like, hey, Microsoft, what are you doing? Like, this is not a good use of your capital. This is not how I want you to deploy the resources, and try to make the argument for Microsoft to abandon it. I don't think there's going to be a lot of pressure from the Microsoft side. So kind of that first piece of just getting alignment from shareholders and boards, I think is probably there. I wouldn't see that as a big risk. The next one is the performance of Activision and the market in the next year and a half. This one is where there's a little bit more uncertainty, I think. So what I mean by this is if Activision announces their WoW subscribers drop in half, the revenue tanks, another internal announcement comes out. I mean, I don't think they can have any more bad PR around like internal policies right now with all the harassment, sexual harassment of former employees, and that bro culture, right? I don't think anything worse than that can come out, but if it does, that could all jeopardize the deal. A really good example of this actually is if we go right back to before COVID, LVMH, the big luxury conglomerate behind like Louis Vuitton, they were in the process of purchasing Tiffany & Co. COVID hit and the market completely tanked. And because of this, sales of Tiffany's dropped and Louis Vuitton or LVMH came back to the table and they said, hey, Tiffany's, we're not paying you what we agreed to. We want a lower purchase price. There was a lot of litigation, a lot of back and forth, a lot of wasted resources. LVMH requested, I think it was like an 11% discount. Ultimately, what ended up happening is they got like a 2.5% discount, I think, and then Tiffany got to pay like a one-time special dividend before the transaction closed. So it was a big legal mess, but I guess what I'm saying is like if Activision really screws up here, something bad comes out, Microsoft could very well say, hey, we want to renegotiate. And I think with Activision's track record, from a publicity standpoint, that's very possible. So, I think that that's probably a pretty real risk here. On the opposite end there, right, if the S&P just completely tanks and valuations are super low, it could just get Microsoft questioning, do we really want to be deploying $70 billion of cash to acquire this company right now? The markets are down, things aren't looking good. Consumer demand for products is dropping, right? And then Microsoft might want to back out and walk away. Now, something to note about this, the deal does have a $3 billion cancellation fee. So if either company decides to revoke the terms of the merger, you have to pay the other party $3 billion. For Activision, that's pretty hard. I don't see Activision walking away from this and then writing a check to Microsoft for $3 billion. For Microsoft, $3 billion is a footnote on their 10Q filing. It's not, it's a lot of money, but to Microsoft, a $2 trillion company, it's not a lot of money, right? They're doing what, $300 billion of revenue a year. It's a very small price to pay to avoid what could be a big mistake. So I could see Microsoft going that route if something bad enough were to come out about Activision. Now the third one, this is the most common thing that actually breaks up most acquisitions, is regulatory issues. We see recently with the NVIDIA ARM deal, there's a lot of regulatory scrutiny, a lot of people saying, no, you'll control the entire market and production, and it's eliminating fair competition. Both the UK and the US regulatory bodies are involved in this, and they don't support the deal and are gonna try to get it canceled. And now there's rumors going on that NVIDIA is looking to quietly back out of this. This happens a lot. I think it happened in the healthcare space recently. Illumina was trying to acquire a smaller, like long read sequencing company. I can't think of the name right now. But these things happen, and then regulatory bodies come in and say, you're gonna have a monopoly, you're gonna control the entire market. We can't allow that to happen. Now, when I look at this acquisition, I think there's a few good things that lead me to believe there's not going to be regulatory interference. The first thing is gaming is just such a small part of Microsoft to start with. The Xbox segment, I think they lump it into their other revenue. It's not the cloud business. It's not their workplace productivity suite. It's not their Microsoft Windows desktop platform. It's not that. It's a smaller portion of their business that they're slowly starting to grow. So I think that's a good sign, is it's not already their core focus and they're acquiring their largest competitor. That's not the case here. So I think that's a good sign. The second thing is, I was reading an article, they're actually gonna be the third largest gaming company after this acquisition happens. So the first two are Tencent and Sony. And seeing Sony on there actually makes me really happy, because what that tells me is regulators are comfortable if you own both the hardware and then also produce the games for the hardware. So if you look at the PlayStation and their games, right? So Sony being the second biggest gaming studio, they control the PlayStation marketplace, and they're also a really big game studio, and regulators have been okay with that. So I think from a Microsoft standpoint, I think that that's a good sign that you're not going to get broken up because you own the Xbox and you're producing the games for it. I think the gaming industry is a with the indie developers, there's a low barrier to entry, which I think is a good thing playing in Microsoft's favor here. As we see like a Fortnite that just kind of pops up overnight, and all of a sudden Epic Games is a massive gaming studio because of that success. So I think that that's going in Microsoft's favor for this acquisition. So I don't think there's going to be a lot of red tape they have to check off the box here. With that said, I'm not a lawyer, so who knows, it could happen, I guess, but I don't see that as a real risk from my investment philosophy. So, I think those are kind of the three big key things here that could break it up. And I think really the only real risk here is if Activision screws up. What I mean by that is if they launch a new Call of Duty and it just completely flops, if World of Warcraft loses half its subscriber base, if their CEO, allegations come out about more sexual harassment and, they don't handle them appropriately or well, I think something like that could very easily unwind this deal with Microsoft just saying, we're not going to take on that risk. We don't want that hit to our reputation if something bad enough happens. Or if the market just completely tanks in the next year and a half, Microsoft may say, actually we're going to hold on to our cash for now and save it in case the market doesn't recover anytime soon. But outside of that, I don't see a lot of risk to this acquisition. I think it's a pretty safe one from a regulatory standpoint, from getting shareholders to buy into it, because I don't think there's a lot of other suitors that could come take Activision in an all-cash transaction. So, I've been thinking I'm probably going to pick up a handful of shares. I don't know how many yet. Probably, put $500,000 in it, 500 to 8,000, not 500,000, just to kind of see. I think it'll keep me watching it and keep me following the acquisition and see if maybe I can get that 20% return. So I'm not going to deploy a ton of capital at it, but just to kind of see what happens, because it seems like it's a bargain price right now, and that the whole market's kind of down, and somehow Activision has been dragged down with it. So I think for tying my capital up for a year and a half, a 20% return isn't a bad deal. But anyways, I hope you found this useful or interesting. I think it looks like an exciting opportunity. I was thinking about maybe looking at options, but I think then you start getting in time value money, volatility, and you're paying for a lot of other things outside of just that discount. But that could be an interesting play as well if you do some research there. But let me know if you have any questions or comments below, and I'll get back to you. Thanks so much for tuning in.